Understanding safes and convertible notes. A guide for startups raising capital from angel investors. At Smart Door Solutions, navigating early-stage fundraising has been a first-hand experience. The mission is not only to build a successful company, but also to share insights with other entrepreneurs on a similar journey. That's why the Founder's Compass was created, a guide to help startups understand fundraising, investor negotiations, and growth strategies. One of the biggest challenges founders face is securing capital while maintaining control over their vision. Raising capital is a critical step for startups, and early-stage financing can be complex. Two of the most common funding instruments when working with angel investors are simple agreements for future equity (CFEs) and convertible notes. Both allow startups to raise funds quickly without immediately setting a valuation, but they have key differences that founders need to understand before negotiating with investors. This guide breaks down CFEs and convertible notes, their advantages and disadvantages, key terms, and how startups can use them effectively in discussions with angel investors. What is a CFE? A simple agreement for future equity (CFE) is a financing instrument created by Y Combinator in 2013 to simplify early-stage fundraising. CFEs allow startups to raise money without issuing equity immediately. Instead, investors receive the right to convert their investment into equity at a future priced round. Key features of SAFEs. No interest or maturity date. Unlike debt instruments, SAFEs do not accrue interest and do not require repayment. Conversion to equity. Converts into preferred stock at the next priced equity round, typically at a discount or valuation cap. Founder-friendly. Delays valuation negotiations until the company has more traction. No investor control. Investors typically do not receive voting rights or board seats. Key terms in SAFE agreements. Valuation cap. A pre-agreed limit on the company's valuation at which the SAFE will convert to equity. Discount rate. A percentage reduction applied to the share price in the next priced round, rewarding early investors. MFN, Most Favored Nation Clause. Ensures investors get equal or better terms if a later investor negotiates more favorable conditions. Post-money versus pre-money SAFE. Defines whether the valuation cap includes the investment amount or not, impacting dilution calculations. Advantages of CFEs for startups. Fast and simple to execute compared to traditional priced rounds. Avoids immediate dilution by postponing valuation discussions. Lower legal costs than negotiating a full financing round. Risks of CFEs for founders. Potential for high dilution if too many SAFEs are issued at a low valuation cap. Lack of investor accountability since SAFE holders do not have voting rights or oversight. Complex cap table management when converting multiple CFEs at different terms. At Kellett. What is a convertible note? A convertible note is a short-term debt instrument that converts into equity upon a future financing event. Unlike CFEs, convertible notes accrue interest and have a maturity date. Key features of convertible notes. Interest rate. Typically ranges from 5 to 8% annually, accumulating until conversion. Maturity date. If no equity round occurs before the maturity date, the startup may have to repay the note or renegotiate terms. Valuation cap and discount. Similar to SAFEs, convertible notes often include a valuation cap and/or discount for conversion. Debts. Convertible notes are legally classified as debt, meaning investors may have claims in case of bankruptcy. Key terms in convertible notes. Conversion discount. Provides a reduced share price for investors compared to new equity investors in a future round. Maturity date. The deadline for conversion or repayment, typically 12 to 24 months after issuance. Interest rate. Accrued interest that can convert into equity, along with the principal investment. Valuation cap. The maximum valuation at which the note converts to equity, ensuring investors receive a fair share. Automatic versus voluntary conversion. Determines if conversion happens at a financing event or investor discretion. Advantages of convertible notes for startups. Provides flexibility by delaying valuation negotiations until a later round. Can incentivize early investors with interest and conversion discounts. More widely accepted among traditional investors who prefer structured terms. Risks of convertible notes for founders. Risks. Debt obligations. If the note reaches maturity before an equity round, startups may have to repay investors. Investor leverage. Some investors may include restrictive clauses, such as requiring board approval for major decisions. Potential dilution. Similar to SAFEs, issuing too many convertible notes with low valuation caps can lead to excessive dilution. How startups can use SAFEs and convertible notes effectively. When discussing SAFEs and convertible notes with angel investors, startups should understand their needs. Consider whether the flexibility of a SAFE or the structured approach of a convertible note is better suited to the fundraising strategy. Negotiate thoughtfully. Ensure valuation caps and discount rates are fair and aligned with the startup's potential growth. Manage cap table carefully. Keep track of all issued SAFEs and convertible notes to prevent unexpected dilution. Seek legal guidance. Even though SAFEs and convertible notes are standardized, consulting an attorney can help avoid pitfalls. Communicate with investors. Transparency about funding plans and future rounds will build trust and long-term relationships with angel investors. When to use a SAFE versus a convertible note. Choosing between a SAFE and a convertible note depends on the startup's financial position, fundraising strategy, and investor expectations. Here are two scenarios that illustrate when one might be more advantageous than the other. When a SAFE is the better choice. If a startup is in its earliest stages and looking to raise capital quickly, with minimal complexity, a SAFE can be the ideal option. For example, a tech startup with a promising idea but no significant revenue or traction might find it difficult to establish a fair valuation. A SAFE allows them to accept investments without negotiating a valuation too early, while giving investors the potential to convert their funds into equity in the next priced round. Since SAFEs do not have a maturity date or interest, they provide flexibility for startups that need time to develop their product and reach key milestones before raising a priced round. Best for pre-revenue startups, early-stage fundraising rounds, and founders looking to avoid debt obligations. When a convertible note is the better choice. If a startup already has some traction, revenue, or clear growth potential, a convertible note might be the better option. For instance, a SaaS startup that has demonstrated product-market fit and is preparing for a significant Series A funding round might choose a convertible note to provide bridge financing. Since convertible notes have a maturity date and interest, they can be more attractive to investors who want some form of return if an equity round does not happen within a set timeframe. Additionally, the debt nature of convertible notes can provide more security to investors who prefer structured financing terms. Best for startups with revenue, fundraising rounds leading up to a priced equity round, and investors who seek structured financial terms. By carefully assessing their stage, financial situation, and investor expectations, founders can choose the instrument that best supports their fundraising and growth strategy. Both SAFEs and convertible notes offer startup-friendly ways to raise capital without immediately setting a valuation. While SAFEs provide simplicity and speed, convertible notes offer structure and investor incentives. Understanding these instruments helps founders make informed decisions when negotiating with angel investors, ensuring their fundraising efforts align with long-term growth strategies. What has been your experience with SAFEs or convertible notes? Share your thoughts and insights.